Roth conversions can reduce future taxes, lower future required minimum distributions, and give you more control over retirement income. It can also raise your tax bill, reduce ACA subsidies, and increase Medicare premiums, and leave you worse off than if you had done nothing. The difference is not whether Roth accounts are good, it's whether paying the tax now is actually better than paying it later. In this video, we'll cover the essential questions to ask before converting: what tax rate you're paying today, what rate may apply in retirement, what other costs the conversion can trigger, and what flexibility it buys you afterwards. This is general educational information, not individualized financial advice. The goal is to help you evaluate the entire transaction, not just the tax bracket that makes the conversion look most attractive. If you're new here, I'm Eric, and this channel covers topics related to approaching retirement that tend to cause anxiety. How much money you need, how to access retirement accounts, how to get health care, etc. I retired 3 years ago at 54, and in that time, I've seen a lot of conflicting and sometimes downright wrong information out there. The Roth conversion only helps when paying tax now produces a better result than leaving the money in the traditional account and paying tax later. The starting comparison is your marginal tax rate today versus the rate that would apply when the money is later eventually withdrawn. People typically expect their marginal tax bracket to change on a curve throughout their life. A low bracket early, higher bracket in the middle years, and a lower bracket in retirement. But we're all different. Someone with a pension and Social Security may have a 22% bracket as their floor in retirement. The taxable portion of a conversion is included as income for that year. There is no income ceiling that prevents a Roth conversion, and conversions completed after 2017 cannot be reversed. That makes the amount and timing worth planning before the transaction is completed. Rushing a transaction and making a mistake can lead to paying more than you planned with no way to back out. And don't forget that the funds to pay the tax have to be available. When someone is younger than 59 and a half, that normally means a checking or a brokerage account. Consider a simplified example. Morgan is early in her career, single, and has $25,000 in a traditional IRA and enough cash outside the IRA to pay the conversion tax. Assume the investments grow to $150,000 before the money is withdrawn in retirement, and her marginal rate stays the same. We're going to ignore state taxes and other income interactions so that we can isolate the tax rate comparison. So we'll contrast leaving the money in the traditional IRA versus converting it to a Roth IRA and compare taxes paid today to taxes paid in the future. If she converts the $25,000 today at 12%, she will pay $3,000 for the privilege. Keeping it simple, she withdraws from savings or a brokerage account to pay that tax. Her reward is knowing that the $25,000 will grow over time. We'll estimate it grows to $150,000 by age 60. At that time, the entire amount will be available for withdrawal and she won't owe any income taxes on it. Contrast that with leaving the money in the IRA. The $25,000 still grows to $150,000, but she also has the $3,000 available that she used to pay the conversion tax in the other example. That $3,000 also has earnings over time. We'll apply the same multiplier and assume it's worth $18,000 at age 60. A caveat here is that it likely would be taxed as capital gains rather than a regular income, but let's keep it simple. As long as she withdraws only enough to stay in the 12% tax bracket when she's 60, she's effectively paying for the withdrawals from the earnings from the $18,000. In this example, the conversion creates some value because while Morgan pays 12% on both, the money and the Roth can be pulled out in any amount needed without spiking her tax rate. While the tax paid from the traditional account assumes regular annual withdrawals, if she left the money in the traditional IRA and withdrew it in one lump sum, her marginal rate would skyrocket, and she would end up paying 22 and 24% on most of that money. In the Roth, she can pull out as much as she needs without that. Now change only one assumption. The tax rate is 22%, both when the conversion occurs and when the money is later withdrawn. You'll notice that this is a very similar example to the first, the major difference being the higher tax rate, 22% versus 12% before, and the amount of taxes paid reflect that. If the outside cash grows at the same rate, the two strategies can produce similar after-tax wealth before accounting for taxes on that taxable investment. In this case, the results come out to be substantially the same. The conversion did not manufacture savings. It only changed when the tax was paid and which account held the assets. This is a very important point that many simplified conversion discussions skip. Growth inside the Roth doesn't have a special advantage over growth inside the traditional account when the tax rate is identical and that comparison is made correctly. The traditional account grows tax deferred and the Roth grows tax free, but the traditional balance also includes money that has not yet been paid to the government. The tax rate comparison is not the whole decision, however. Roth conversions often create their greatest value through the flexibility they provide. Being able to use funds in a Roth allows greater control over reportable income, which has wide-ranging benefits. A conversion reduces future traditional account balances and can therefore reduce required minimum distributions. Roth IRAs and designated Roth workplace accounts aren't subject to lifetime RMDs for the original owner and, of course, under current law. That can provide more control over taxable income later. Roth conversions are a major way for someone to access retirement funds early. There's a 5-year delay before you can access each conversion, but many people retire well before 59 and a half and live off of the funds they converted years prior. It just takes a bit of planning. If someone stops working before collecting Social Security, they may have quite a bit of headroom in their tax brackets to make Roth conversions. Someone with a paid-off home and low expenses may even be able to do small conversions and stay under the standard deduction. A conversion may also help a surviving spouse filing as a single while managing much of the same household retirement income. It may improve the tax character of assets left to heirs. It can create a source of tax-free withdrawals for years when additional taxable income would be very costly. If you're finding this to be useful, consider hitting the subscribe button so you stay aware of my new videos on topics related to the transition from work to retirement. And hitting the like button would help YouTube put this video in front of others that may find it useful. There are several areas where people benefit specifically from having a lower reportable income. ACA healthcare subsidies are tied to household income, and income also affects how much of your Social Security benefits may become taxable. Someone retiring at 62 and drawing from a traditional IRA is likely to see less spendable income than someone the same age drawing the same amount from a Roth. If that's a situation you'll be in, please see upcoming videos on ACA healthcare as well as Social Security. But the conversion itself can create costs beyond the stated federal bracket. The added income may affect marketplace healthcare insurance subsidies. The taxable portion of Social Security can increase state income taxes, capital gains planning, deductions, credits. The one with the most potential for surprise is Medicare IRMAAs, which use a 2-year look-back. You may have forgotten the conversion by then, but Medicare has not. It's also possible to have unintended consequences from converting too much. Say you convert everything from taxable IRA/401k into Roth. You aren't working, you have no taxable income, and are living off of Roth distributions. You sign up for ACA health insurance, and you're likely to have one of two scenarios. If you live in a Medicaid expansion state, your state puts you into Medicaid. Now, Medicaid quality varies widely from state to state, but there is a new in 2027 work requirement for many Medicaid recipients. You can satisfy it by having at least $580 per month in income, but you need to plan for it. If you live in a state without expansion Medicaid, you may be denied to Medicaid but still have too little income to qualify for ACA subsidies. That can leave you paying the full unsubsidized premium for your insurance. The true cost of the next dollar converted may therefore be higher than the bracket printed on the tax table. How the tax is paid also matters. Paying from cash outside the retirement account preserves more money inside the Roth. Withholding tax from the converted amount leaves less invested, and someone under 59 and a half may create an additional early distribution penalty issued for the amount that was carved out to pay the taxes. The conversion itself is also just part of the story. It's not as simple as open a new Roth IRA, do a transfer from a traditional, pay the tax, and next month I can start using it. There are special rules that can trip you up. I made a separate video explaining the rules of Roth IRA withdrawals that would be especially useful for anyone planning to use Roth conversions to fund the period before they hit age 59 and a half. A Roth conversion is best viewed as purchasing future tax flexibility. Sometimes the price is attractive because current income is temporarily low, future rates are expected to be higher, or large RMDs are likely. Sometimes the price is too high because a conversion pushes other income into costly territory. The correct question is not simply, should I convert to Roth? It's really a three-parter. What tax and related costs will I pay now? What costs am I likely to avoid later? And what flexibility does the conversion buy? A Roth conversion can be valuable, but it is not automatically a tax-saving move.